Hello and welcome to our first quarterly Global IFRS update webcast for 2025. There's a lot of talk about tariffs in the news at the moment. So one of our highlights today we will be discussing the impact of tariffs on accounting. We will also give a short update on new amendments that were issued recently by the IASB related to IFRS 7 and IFRS 9, so impacting financial instruments. My name is Gerda Burger, and I'm joined today by Gerda Burger and Netta Mikkilä from our Global Reporting Services team. So, let's start our discussion today about talking about tariffs. Now, as I said, there's been a lot of discussion about tariffs even before the new administration and President Donald Trump took office in January. So, Gary, do you want to give us a bit of background?
Yeah, sure, Curtis. I guess just starting out from an overall perspective, as you mentioned, there was talk about tariffs before the end of the year, and then things really got kicking off in Q1, where the tariffs were implemented, they were paused, they came back in. And so there have been a lot of tariffs by the US onto other countries, and then obviously retaliatory tariffs coming back to the US. You've got a lot of additional cost that's in the system now that we had before, and obviously that affects supply chains for some companies depending on the types of goods and services they sell and they get through their supply chains. And when you get increased costs, there's obviously accounting implications as a result of that. Yeah.
So if we then look at the accounting implications and we use an example of a December 2024 reporter, what do they need to be conscious of?
Yeah, so, and this is the question I guess we did look at for December 2024 reporter, was at that point in time, the key question was post-balance sheet events. So as we know, we've got the standard IAS 10 that tells us you need to look at events that have come after your reporting period, both favorable and unfavorable, and you need to decide whether or not those events are what we call adjusting or non-adjusting. So adjusting events, we go back and we actually adjust the financials before we issue them. Non-adjusting events typically is just disclosure to the extent it's material. And I think the key question we had here was, is the implementation of the tariffs, then the freezing of the tariffs, the re-implementation of the tariffs, counter tariffs, should all of that have been taken into account for a December 2024 year end? Now, most December 2024 year-end companies or public companies will probably have already reported by the time you see this webcast. But I think what's important is this is probably an ongoing implication. So regardless of when your period end is, we imagine this issue around uncertainty and tariffs is going to be here for a while. And so this might still be relevant for you if you're a March reporter or thereafter, depending on how the situation evolves. But if we take your hypothetical December 2024 entity, I think the answer is it's not as simple as it maybe sounds. So the question is, obviously, the actual implementation of the tariffs only came out after December 2024. And the question is, well, should I go back and adjust the numbers that I had at December 2024? And I think, as I said, it's complicated. Maybe I can just explain some of the complication via some examples. So if we start out, for example, if an entity had financial instruments that were measured at fair value, so a lot of financial instruments or maybe some investment properties, typically when you have financial instruments measured at fair value, all of the uncertainty is taken into account in the valuation technique. And as a result, anything that happens after year end is effectively ignored because all of that, a market participant was taking all of that good stuff into account when they did their estimation of the fair value. So that one, I'm very surprised you probably wouldn't adjust any of those. If you take something, for example, though, like a non-financial asset and a piece of PPE, and at year end there was no issue, there was no impairment indicator. After year end, the announcement comes out, now you're like, oh, that's bad news. That's probably an indicator that I need to do an impairment test. The event that gave rise to the impairment indicator happened after year end. And as a result, you'd say, well, that's a non-adjusting event because the impairment indicator clearly happened after year end. So I can't go back and say, well, I've got the indicator at 31st December. I should retrospectively do an impairment test. And then you get what I call the really tricky one somewhere in the middle, which is when you've maybe got items like expected credit loss, financial instruments that are measured at amortized cost, subject to ECL, or you might have had a goodwill impairment test that you have done at year end. And there I think the question really is, how did the entity at year end build in the expectation that there might have been tariffs? because clearly, as you mentioned at the outset, Gerda, there was already announcement or talk about tariffs before year end. And if you're doing a expected cash flow modeling or any kind of probability modeling, where in that kind of calculation did you take into account the probability of tariffs? And that one, I think, is the more difficult one, because the question is was your estimation of or probabilities of those tariffs coming in supportable and made sense based on the information you had at the reporting date? In some cases, the information after the reporting date might give you more evidence about how you did your probability assessment, and you may need to make tweaks, or you may need to make what we call refinements. I think the important message, though, is you should not use hindsight. So you shouldn't go back and go, okay, well, now that I know a tariff was implemented, I'm going to assign 100% probability to this assessment of what the tariff was going to be. So, as I say, hopefully that's given folks a flavor for it's maybe not as easy as it initially sounds, but hopefully that's helpful for folks to get to the right answer to the extent you're in that situation.
Thanks, Gary. That is very helpful. Are there any other areas that our 31 December reporter need to think about?
Yeah, so again, staying on the topic of IAS 10, just because you might not have an adjusting post-balance sheet event doesn't mean you might not need to think about, for example, the disclosures. So even if it was a non-adjusting event, there might still be relevant material information that you might need to disclose as it relates to tariffs. And then there's one other thing that's probably worth mentioning, which is folks may recall that for going concern assessments, which hopefully the impact of tariffs isn't so significant that it does creates a going concern issue, but to the extent it does, worthwhile reminding folks that any going concern assessment always is considered to be an adjusting post-balance sheet event. So to the extent that the implementation of tariffs is so significant for an entity that it calls into question the going concern assessment, those adjustments to any types of valuations or assessments would always be considered adjusting.
So that was kind of considerations as at year end. So Netta, what do we need to think about after 31 December 2024?
Thanks, Gerda. So I think Gary already implied that this is not just a year-end issue. It's actually something that entities need to consider going forward. So I think, as you can see on the slide, we've highlighted several key areas that we would expect entities to pay closer attention to, and as potential impacts of tariffs. And I think first one I would like to point out is the cost-based impact on impairment models. So I think going forward, and on an ongoing basis, it's important for entities to assess whether they have the correct cost basis for their assets that are subject to impairment analysis. So I think regardless of the conclusions that were drawn for the December 31st reporting, so with respect to the impairment analysis, the entities will now need to consider whether those assumptions and conclusions continue to remain applicable for any subsequent periods. And I think you mentioned the tariffs and the freezing of the tariffs and the counter tariffs, so effectively the circumstances change. So management will need to consider the inputs into the impairment analysis, such as the sales volumes, the production volumes, and also margins to determine if and how they will be potentially impacted as a result of the tariffs. So I think these conclusions and any resulting adjustments will need to be fed into the impairment models. And I think, for example, the higher tariffs are likely to lead to increased input costs, which then put a lot of pressure on margins. Mm-hmm. And I think, however, you cannot just stop looking at the margins, because as a result of the tariffs, you have to actually maybe offset those costs in terms of increasing sales prices, which then could actually, impact the demand for your goods. Mm-hmm. And that actually could then have another negative impact on your impairment. And I think one of the key points for entities to keep in mind is the disclosures. Even for interim periods, it's not just about the accounting policies, it's about the material judgments and estimates what IAS 1 requires entities to consider. And I think these would really include sensitivities to critical estimates. So I think next, as you can see on the slide, we've highlighted inventories, so capitalizing tariffs into the inventory costing. So I think this is a key issue for entities to consider also when it comes to tariffs. I think generally the cost of inventories should include import duties and other taxes, provided that they're not recoverable from the tax authority. So the tariffs are considered costs to bring the inventory into its present condition and location. So the tariffs would likely be capitalized into the value of inventory. And I think depending on the price elasticity of demand for the products in question, it might put additional pressure onto the margins when trying to sell the inventory. And I think actually perhaps you have to start thinking about the realizability of the carrying value for those goods in your inventory. I think just for everybody to remember, inventory should be valued at lower of cost or net realizable value. And I think entities should also think about the supply chain when the tariffs are, applicable. I think there's a good example which I would like to point out. Like if goods are actually shipped to a customs-free zone before, where they are stored before they're actually sold to the end customers. So any tariffs or import duties that are incurred later would not be capitalized into the inventory until after they've actually been shipped out of that customs-free zone. So I think that's an additional point to consider.
That's a good example. So do we need to think about deferred tax assets?
Yes, actually, that's the third good point to bring out. So I think, yes, absolutely. So entities do need to consider the recovery of deferred tax assets. So any additional costs that are incurred as a result of these tariffs may need to call into question again the recoverability of deferred tax assets. So I think entities again need to consider the impacts of any additional incurred costs when they prepare their forecasts that support the recognized deferred tax assets. And I think a good thing to keep in mind is that remember the consistency for the forecasts that you use for the recoverability of deferred tax assets when you analyze those compared to the impairment analysis that you do for your non-current assets. So I think that's a good point also to keep in mind.
Thanks, Netta. And Gary, what about how these tariffs impact what we present in the income statement?
Yeah, so I guess, Netta mentioned the word tax and everyone thinks tariffs are a type of tax. And I guess the question that springs to mind is where in the income statement should these costs be presented? Maybe some folks feel intuitively this feels like a tax, but unfortunately, the requirements, in IAS 12, which is our standard on taxes, to present something as a tax expense, it needs to be based on a net notion of a taxable profit. And these amounts are obviously gross amounts based on the value of the goods you import. So as Netta said, these are effectively a direct cost of the acquisition of inventory and should be presented as such rather than as income taxes. So they would need to be part of your cost of sales to the extent they relate to inventory or PPE to the extent that they're part of PPE.
Thanks. And non-GAAP measures?
Yeah, so obviously to the extent, and as Netta pointed out, to the extent that this is going to affect potentially margins and people trying to demonstrate comparability from pre or post tariff situations, people might think that non-GAAP measures are a way to provide that. Again, very little guidance in IAS 1 on non-GAAP measures. Obviously, one day when we get to IFRS 18, we'll get management performance measures, but today, very little guidance on non-GAAP measures. So, again, additional line items can be provided, but again, there's some rules around that. Line item subtotals, provided they are measured in accordance with IFRS, they provide labeled in a clear way, they're not misleading. So again, people may think about how they can do some of that, but I imagine some people might want to tell a story via non-GAAP measures, in which case, you would need to look at your jurisdictional requirements and restrictions to determine what may or may not be applicable or appropriate within the financials or outside the financials. So it's a bit of it depends.
Thanks. There's clearly a lot to consider. And I think, Gary, you did mention this earlier, but we obviously used as an example a 31 December reporter, but it's equally applicable to any other year-end reporter and kind of what's the current status of tariffs at that date.
Yeah.
So this is clearly a very fast-moving and changing area which reporters will need to consider as they get to their year ends and also as they move on after those year ends. So let's move to our next topic, which relates to new amendments and standards coming effective. Netta, do you want to share a bit with us?
Sure. So I think we wanted to briefly mention the few amendments that will be applicable from January 1, 26 onwards. So I think the key here again is that early adoption is obviously possible, permitted, subject to local endorsement. But I think it's a good thing to start thinking about these two amendments already now. So I think the first set of amendments relates to contracts that reference nature-dependent electricity, a very hot topic if we think about it currently in the marketplace. So I think these types of contracts, they have become much more common recently, and I think the accounting for them has been particularly challenging because the source of the underlying electricity cannot be controlled by the entity due to the conditions that are imposed by the nature. So I think, IFRS 9 and IFRS 7 have been amended, and I think why? So I think there are three things I would want to point out. One is to clarify the own use requirements for these contracts to buy and take delivery of nature-dependent electricity. The other one is to help apply hedge accounting when a nature-dependent electricity contract is actually designated as a hedging instrument. And thirdly, it's also to add new disclosure requirements, which we obviously all like. And you need to actually look very carefully into those because there are new requirements for these contracts that you account for as own use when you apply these amendments. I think for more information about these amendments, we'd recommend our latest episode. You can listen to the IFRS Talks podcast and also refer to our in-depth on accounting for contracts referencing nature-dependent electricity. And I think the next set of amendments relates also to IFRS 9. It is actually a very favorite topic of mine as well. And these relate to the timing of recognition and derecognition of financial assets and financial liabilities. So these amendments were made to address the challenges entities have experienced in practice, in particular when a receivable or a payable, a financial liability is settled through an electronic payment system. I think these amendments introduce also an election to derecognize a financial liability before its original settlement date when it is settled in cash through an electronic payment system. And I think when obviously other specific criteria laid out in the amendment are met. I think for this one also, Gerda, we obviously have more information available at Viewpoint, and I really recommend to read if this is applicable.
Yes, we issued an in-brief on that, so
yes,
that is
exactly
good to read. Thanks, Netta. And then lastly, talking about nature-dependent electricity contracts, do you have some sustainability news to share with us?
Yes, so let's move to the last piece of the news. So this is on sustainability reporting. So we wanted to share with you that our second global quarterly webcast for sustainability reporting is now out there. And it's available to catch up on if you did miss the live version that was out there. And I think, there's a lot going on in that space. So the majority of the webcast covered was the release of the European Commission Omnibus Package proposals. So the package includes proposals related to the Corporate Sustainability Reporting Directive, as well as proposed changes to the Corporate Sustainability Due Diligence Directive, the Carbon Border Adjustment Mechanism, and regulations related to InvestEU and other EU investment programs. And I think what's worthwhile mentioning also is that the European Commission also issued a draft delegated act to propose changes both for scope as well as simplification to the EU taxonomy regulation. So I think given the fast pace of the sustainability reporting world and this major update, I would highly recommend that you actually take some time and watch this webcast if sustainability reporting is at all relevant to you. So there's a lot of good information in that, Gerda.
Thank you. This brings us to an end of today's webcast. Gary, Netta, thank you for sharing your insights. And thank you to our viewers for making time to watch this webcast. We hope you found this update useful, and we look forward to seeing you later in the year for our next webcast. We hope you enjoy your day.